for global investors. In fact, let's chat a little bit more. We've got Andrew Freris joining in on the show to talk about exactly that. Andrew, hi, good morning. Great to have you today on ET Now. Andrew, the Fed rate hike odds for September are nearly halving in just about a week's time. What is your own sense on what the Fed likely move and commentary is going to be like?
I expect that they may very well want to see some more inflation numbers because they only had one good inflation figure that came down. And on the basis of that, to decide that they are not going to increase, or rather they will plan to cut interest rates, I just don't see it. I still think that they will need to increase interest rates by the year end. And this is what I'm telling my clients. It's the Christmas present is going to be an increase in interest rates. It's as simple as that. Why? Because I don't think there will be a trend in inflation sufficiently strong to point them out that they can actually cut. And if they decide to stay, then they run the risk that they will be behind the curve.
Andrew, curious to know, therefore, if there were to be an increase in interest rates, then I would suppose tech stocks in the US would continue to be under pressure.
Well, they will continue to be under pressure whatever happens. That's the other thing that I tell my clients. In other words, if we decide that there are going to be a cut in interest rates, I wouldn't tell you that that's a good reason to buy tech stocks. Everything we have said about their overvaluation, the exaggeration about the expectations of the earnings that are going to support all this expenditure are simply absent. Therefore, I have been telling my clients for nearly 6 months now, progressively cut back on American stocks and in particular on tech stocks, except on US defense stocks. Very clear.
Right. Andrew, I also want to throw focus on what's happening in the Far East here in Japan, because the 10-year yields just hit a 3-decade high. Wanted to understand whether this is the start of a genuine BOJ normalization cycle, and how do you think that's going to sort of impact, investing environment in Japan and across the globe as well?
I will try to give you, it sounds condescending, but it isn't. For 25 years, I was a professor of economics. And there is one thing that I drove home to my students in market economics. You can either control the amount or the price, not both. And Japan would like to control the price. All right. In other words, they want to see the yen to strengthen. And if they're going to do this, they have to cut the quantity. In other words, they will have to increase interest rates. They cannot have it both ways. So they have been trying a game which never works. In other words, they wanted to see the yen increase against the US dollar, and in the process, not to increase interest rates. Well, that doesn't work. It's as simple as that. So yes, I think that if the Bank of Japan decides that they are not particularly concerned anymore about the yen, okay, then yeah, they may very well decide to cut interest rates, but they can't. Also, and that's my second point, if you look at what the Japanese are basing their forecast, it's a mess. There are 4 basic CPI indexes, some of them core, some of them super core, all of them, read my lips, all of them well below 2%. So what's their problem? Their target is 2% and the actual rate of inflation is well below 2%. So why are they worried about inflation at all? And the answer is but inflation in the future may increase. Well, all right, but there is really very poor arguments to substantiate that. That, in other words, Japanese inflation is going to accelerate well over 2% in the next 6 months. So I'm having a Bank of Japan saying that we are very concerned about inflation when they shouldn't, and their quantitative numbers are well below the 2%, and they still want the yen stronger, but they still don't want to increase interest rates. I'm sorry, it just doesn't make any sense. 101 economics, Bank of Japan fails to pass my course.
Right. But Andrew, if BOJ were to hike in September, how much of yen carry trade unwind should global markets brace themselves for?
Quite a lot, because of course, given that the likelihood of United States increase in interest rates is relatively poor, then this is going to increase the differentials versus the yen, and therefore strengthen the yen, and therefore weaken the US dollar. Boy, this is Nobel Prize economics for you early in the morning, huh?
Andrew, I wonder whether the thesis changes at all if things were to resolve themselves in West Asia. I know it's a far cry, at least at this point in time. But if things were to change, and there is a November midterm election which the US administration now faces, if things were to change, could the thesis also change along with it?
I'm sorry, I don't quite follow. Things what should change and
So
where in the States?
if the bottlenecks with regard to crude were to go away and crude were to come back off towards maybe $75–80 on the barrel, could the thesis with regard to rate hikes change?
First, I don't think that the Iranians are going to let go of Hormuz, and therefore this will continue the pressure. Second is I'm a firm believer that give another 9 months to 1 year and Hormuz will not matter. It will just be another piece of sea that is of real, very little importance as far as oil is concerned, because the oil market would have found different ways. They would have found different routes. They would have found different sources. So I stopped getting too obsessed about Hormuz. However, the Iranians will not let go. And if they don't let go, they will continue to drop the occasional bomb on boats passing, and therefore the United States will also continue to drop the occasional bomb on Iran. I'm afraid a year ago I said that when this war starts, it's going to take forever. It is not going to stop. It simply changes form. Iran and United States will continue to fight each other for the months, if not for the years to come. And we might as well get used to live with that and also get used to the idea that Hormuz very soon will not matter. And therefore, the prices of oil will be reflecting different things.
Point taken. Where do you invest, Andrew, at a time like this? Do you go after bonds where bond yields keep going up? You clearly seem to be of the view that there's still some way to go with regard to bond yields going higher. Don't invest in tech. Where do you go after?
Well, as I said, as far as United States is concerned, I don't like. I advise my clients to lighten up, continuously lighten up on all your stocks, particularly techs, except defense. I still stay very, very bullish on defense. Have been there for nearly 5 years. It is so obvious now that it is almost embarrassing for me to come out and tell you I'm bullish on defense. Of course I am. Okay, but there are a few other markets in Asia that continue to do all right. The problem with Taiwan and Korea is, of course, they are over. They have overtaken in terms of returns the S&P for months now. But of course, the problem is their strong performance is still based on tech. And if tech, as I expect, will continue to be under pressure, that's very difficult to carry on saying, yes, I'm bullish now on South Korea and on Taiwan, although they are good, strong performing economies. Singapore is doing quite well. Not a great deal to choose, but I like telling my clients that very slowly they should start buying U.S. government bonds because of the potential high yield. Now, however, if they buy them now, okay, they will get 5%, but very soon they will also find out that they will be carrying capital loss as the yields increase. Of course, the prices comes down, but that's something that they will need to consider in terms of a balanced portfolio and saying, well, now we're going to enjoy some good steady income for the next year, but then we'll have to see when and how the capital loss may be taken off.
Interesting. Okay, Andrew, great to have you today on ET Now. Thank you so much for your time and perspective.